Mark, great to see you this morning. Thanks very much. Your thoughts on what the Home Depot quarter tells us?
Well, Home Depot is almost a perfect barometer for what's happening in the marketplace, and at least the segment of the market that Jerome Powell has a bullseye on. He's told us flat out, we're going to raise rates, we're going to lower inflation, which means slow economic growth, which means demand destruction. And then you have a massive retailer tied to the home building industry that's slowing growth and offering muted guidance. There should be no surprise to investors. There's rarely been such clarity from this Fed chairman about his intent, and the results are clear in the numbers.
Yeah, it's clear in the numbers, but I'm wondering how bad this gets and where we are going to see this spread toward within the economy. Mark, do you think that the housing market right now is in recession?
Well, it is, and it's going to flatten out and decline even more. We have the cost of capital has doubled or even tripled off those mortgage lows. Move-up buyers are going to be stifled by that, especially against the backdrop of layoffs and a weakening labor market. You also have a lot of people with mortgages sub 3%, some as low as 2.5%. So for them to sell and move up, they're going to almost triple their borrowing costs. So that's going to be another headwind against the housing market. So we expect housing to be the drag. And remember, and this is exactly what the Fed controls. They control interest rates, sensitive areas, autos. We've seen used car prices pull back, housing, and this is where the trickle down starts, and we see it as a real factor, limiting growth later in the year.
Yeah, I mean, yields are creeping up this morning. Stocks are trading down. And, Mark, this is what the Federal Reserve wants, right? I mean, we're looking ahead to inflation data this week. We'll see if the inflation cuts into the Walmart quarter. But we've also got the second read of fourth quarter GDP that's coming out on Thursday. And economists are expecting growth still of 2.9%. That would be the second read. We'll get the January PCE out on Friday, Mark. So we've got a lot of data to fill in the holes here. But do you think that the inflation story cuts into the Walmart quarter? Does Walmart see any of that negativity, or is this largely a housing story as represented by Home Depot this morning?
Well, Walmart's going to be a cross-current of a couple of factors. Remember, the huge grocery and essential segment of their business could remain strong and help them not just be solely dependent. It also is a move-down market. As things get tougher, Walmart can benefit. But those are two optimistic ways to look at how you can benefit in a slowing economy. So Walmart might be a relative defensive play, but on an absolute level, they are exposed to a slowing consumer. We see consumers spending down that cash they got from the COVID boost and the government subsidies. We see debt levels now rising, and the cost of their borrowing on credit cards gone up. And remember, that home equity line piggy bank has ended. It's basically dried up. So all these factors are going to hurt retail. They're hurting the consumer, and that's why looking out in this year, we see flat, muted, maybe even slightly negative growth.
So in other words, we could still see a recession in your view?
Yes, but it doesn't have to be a severe one, and that's what people need to realize is, look, the bad news is already out. We had the rate spike. Oil prices have seemed to come under control, and valuations have come down from frothy levels to just slightly above where we see them historically. So from here, we don't have to see a massive recession, a massive stock pullback, more of a grindy, unattractive stock market, slow growth, and nothing to get excited about as we work through what we think is going to be a mild recession.